All right, everyone, welcome to this short video where I'll be showing you why the hedge fund community love the overnight carry trade when investing in the Forex markets, okay? I just closed a trade with my VIP members trading the dollar against the Japanese yen. We caught this big drop in the currency markets, and all the Bloomberg articles are telling you that is because of the unraveling of the carry trade, because the Bank of Japan just raised interest rates. You've got a Reuters headline saying the aftershocks of the carry trade at the heart of the market rout, okay? And then you've got over here, global carry trade unwind extends the yen's gains. So I was buying the Japanese yen because interest rates in Japan are going higher and the interest rates in the United States are going lower. And what so many people don't understand, and I only just realized this when I was saying it to my members, is that when you're trading a currency pair, people don't understand that whatever currency has a higher interest rate than another currency is going to make that currency go up in value, because hedge funds can get free money into their trading account every day they hold the trade open, okay? And you need to understand why, because when you do understand why, you'll be able to catch big moves in the currency market. So come over, enjoy the video, like, comment, subscribe, and watch this change your trading.
Okay, cool. Thanks.
Right, everyone, I know you've been seeing the stock markets crashing over the last few days, with stock markets down 10%, Bitcoin down 27%, and dollar yen down 10%, okay? And it's all down to what the headlines are telling you, the unwind in the carry trade. The carry trade strategy, which has been using the Japanese yen to finance the purchase of risk assets all around the world, is coming to an end, okay? So you can see in the Bloomberg headlines, global carry trades unwind extends, the pesos drop and the yen gains, okay? Another report by Reuters, aftershocks of carry trade at the heart of the market rout. All right, JP Morgan says the unraveling of the carry trade is only halfway complete. Some more selling is likely to happen, potentially, okay? So I sold with my members dollar yen, and I got into this trade with them, and I told them we closed our trade yesterday, as you can clearly see over here. And I set the trades to them just a few days before, okay, setting them up for the sell-off. We had a sell stop order for dollar yen down here before the market fell, and we had a sell stop for euro yen as well below before the markets fell, okay? And obviously the members followed the trades, made some amazing money. Kevin sent me a screenshot, sorry, £2,700. James made £1,000. Shane, a couple hundred. Jamie, 500. Samuel, 2,000. Zabir, 2,000. Again, following the trades. George, a couple hundred, £300 profit. Ryan made £1,000 again, following the same trade. So I want to walk you through how we took these trades, why I shared it with my members, and it was all down to the understanding of the carry trade. Okay, so just understand, in 2022, when the US Central Bank started raising interest rates in March because inflation was at 8%, this is one of the macro spreadsheets that I teach my members of how to use when we're educating them on macroeconomic fundamentals, which really drives the markets, okay? So inflation was at 8%. The central bank is trying to get inflation down to 2%, right? So what did the Fed start to do? Raise interest rates. March 2022, the first rate hike happened, okay? And they took rates from 0.25% up to 5.5%. Rapid interest rate increases in the United States. Japan last week only just raised interest rates for the second time this year, and they've only gone up to 0.25%. So where the Fed was raising rates from 2 years ago, Japan's rate has only just got there. Now, why is this important to understand? Well, what you can understand is that as the US Central Bank has been raising interest rates, a lot of people don't understand what the overnight carry trade is. So if I'm taking a trade in the markets, right, and I'm selling the yen to buy the dollar, which is if I'm taking the dollar yen trade, if I'm buying that currency pair, when the Federal Reserve is raising interest rates, the overnight interest rate which the central bank sets is actually the same interest you get paid into your trading account, or money that you get debited out of your trading account every day you hold the trade open. Okay, people don't know this. Okay, it's called the overnight carry trade. So if I sell the yen when interest rates are at 0.1, as they were all of this year until they just started raising interest rates, and when the Fed started raising interest rates, right, the overnight carry trade, meaning if I sell the yen to buy the dollar, if I'm trading, let's say, 10 lots, for an example, or let's say I'm a big fund, right? Let's say we're a big $1 billion fund, right? You're trading 1,000 lots position over 365 days. If I sell the yen to buy the dollar, I don't pay any interest on the yen that I borrow. and I get paid 0.25% interest on dollars I buy. So the broker will be crediting your account if I had a lot size on of this position. Obviously, only the big institutions could take these lot sizes, but look how much are we making a day? 10 grand a day. So do you see, as the interest rate in the US was going up to 0.5%, that's now 20 grand a day. 1%, 30 grand a day. 2%, 60 grand a day. 3%, 90 grand a day. 4%, 120 grand a day. 5%, where rates are pretty much right now in the United States, 150K a day. Where rates are right now, 5.5%. If you sell the yen and buy the dollar, okay, that's how much interest you'd be getting paid. Free interest into your trading account every day you hold that trade open over 365 days. This explains, if I incorporate the bond market, and I can give you a really good view why this happens to drive currency pairs. Okay, so look, let's take the US 10-year government bond interest rate and USD JPY, because you'll see the correlation between the two. Now remember, government bonds are the safest place you can park your money, right? And government bonds, the interest rate on the government bond, especially the 10-year, which is the most highly liquid asset in the world, which is the most traded, look what happens. When the Fed started raising interest rates in 2022, as the interest rates are going up, meeting by meeting, look at dollar yen on the left-hand side. Can you see that as the interest rate is rising in the United States, dollar yen is rising in the currency pair on the left-hand side? As soon as you get a drop in the bond market here, look what happens, dollar yen drops. And then as soon as the interest rates go up again in the United States, dollar yen goes up. See what I'm saying? Soon as the interest rate in government bonds go down, dollar yen goes down. Soon as bond yields go up in the United States, paying more interest on the 10-year government bond, dollar yen shoots up. And then you get a period here where the interest rate on government bonds decline to this period here. Look at dollar yen, it declines. No surprise, when does dollar yen start to rise again? Look, as soon as the interest rate on government bonds start to take off from here, look at dollar yen on the left-hand side. They're moving at exactly the same time. And then you get a pullback here. No surprise, dollar yen goes down. Then you get yields going up again, interest rate that is on government bonds, dollar yen shoots up, and you've now had a period where the interest rate is tumbling down on government bonds, dollar yen selling off straight away. So this is why I took the trade, because what you need to understand is this: the reason the interest rate on a government bond is going up or down over here, the reason this interest rate is going up or down, because this interest rate on government bonds is following what the Federal Reserve is doing with their interest rate and what the markets are predicting, more importantly, the Fed is going to do in the future. So this spreadsheet over here is where we use implied rates. We understand what the markets are predicting for interest rates by the Federal Reserve meeting by meeting. And currently, they're expecting sharp interest rate cuts in the United States, 7 in the next year. And this is why the bond market is now rolling over, because the markets are pricing in these interest rate cuts. So remember that free interest I was just telling you about on your trading account every day you hold that trade open? Well, look, it's now hit a peak, and the markets are predicting rates in the US are going to go down to 3.5% by December next year. And where's rates in Japan going to go to? 0.5 by the end of next year. So look at what happens to the interest rate difference. You could be earning 160 grand a day, but by the end of next year, that interest rate of 160 grand a day is going to go down to only paying you 86 grand a day. So what do you think happens? Investors who have been piling into this carry trade to earn that free money overnight every day they hold that trade open, if they sell the yen and buy the dollar, and they get the exchange rate going up in value. Let's say you buy down here and it's gone up by 40% in value. You've made a 40% return on the dollar's value against the yen, which when you close the trade, you're going to buy 40% more yen, right? Because remember, to buy the trade, you sell yen, buy dollars. To close the trade, you sell dollars back into the yen. So you get on a lot more yen, okay? And then the brokerage is going to convert that into whatever currency your trading account is denominated in, right? And you've been getting that free interest, so you could be making like 45% return. Now think of $1 billion fund. That's a huge amount of money, right? So this is why, soon as investors are predicting now the Fed is going to cut interest rates aggressively, as we can see over here, they quickly want to close that trade. And this is why the headlines are saying the overnight carry trade unwind is exacerbating the moves. And they're saying it's only half done. Okay? The carry trade is at the heart of the market route, because investors who've been piling into this trade, and it's not just in the currency markets, What investors also do is they sell the yen to buy the dollar, and they buy government bonds because the government bonds is a safe security you can buy. And if it's paying you 5% interest as it was here, that's good. You don't mind, especially if you've also made 40% return on your money. Happy days. But for investors that may have bought at the top here, yes, you're safe as long as the exchange rate doesn't drop by more than the interest you're receiving on the bond market. So let's say you're receiving 5% interest and now the exchange rate drops by 10%, well, you've lost money. This is why they're saying it's the carry trade unwinding, because investors who have been holding this 40% profit, as I told you over here, in exchange rate value going up in their favor, now that they're cashing on their trades, now that the markets know that the carry trade's over, interest rates in the United States are not going to go any higher. They don't want to be the one who has a 37% return, look, on the dollar yen over here, turn into now 26%. And if JP Morgan have it right, we're only halfway there, that 26% return on your money now may turn into only 12%. And if you're trading billion-dollar funds, that's a lot of money to lose. So everybody quickly closes their trade. So for the carry trade to work, what you need to understand is investors are looking to always finance the purchase of a currency with a higher interest rate than another country's currency, so they can earn that free overnight interest. And the higher the interest rate difference gets, the more money floods into that trade, because everyone's trying to get that free money every day they hold the trade open. Plus the exchange rate going in their favor by hopefully 40%, and they're making a big return. But the moment investors realize that the overnight carry trade is going to now pay less interest, you're going from making 100 grand a day to 90 grand a day. Well, you know, everyone wants to cash in that trade quickly because they understand that the trend has ended, is done. And they don't want to be the one holding this asset, the dollar or bonds, when it drops 10% and now the carry trade ain't working no more. And you want to make sure you're locking in that appreciation in the exchange rate of 40%. So the carry trade, just to break it down and make it fundamentally easy for you to understand, is when interest rates are going higher in one country relative to another country, investors are using the yen as the funding currency because interest rates have been very, very low. Right now, they're 0.25%, right? I remember earlier this year, they was at 0. So this carry trade was paying even more. It was so profitable for investors, right? But now investors are realizing the rate is going to go lower. They want to cash in on the trade because they've made a huge profit in their trades. And yes, you are getting that free interest overnight still by holding dollar yen open. But again, remember, but this move here of 20-30% is a lot more than getting 5.5% over 365 days, right? Remember, this difference right now of 5.5% to Japan's 0.25%, this is over 365 days you're getting paid this interest. But this is only this is a 5.75% difference, right? Sorry, 5.5%. 5.25%, apologies. 5.5, 0.25%. But remember, you're going to get paid 5.25% interest over 365 days, which is obviously a good amount of money you're going to be making. But if you're already locking in 35%, you don't want that to drop down to 20%, 10%. That's a lot of money. So for you to trade the currency markets, there's two things you need to understand. Where are the markets predicting interest rates to go? Because that's going to dictate the overnight carry trade, how much you're getting paid. So for you to trade the currency market successfully, you need to understand why the carry trade exists and how to implement it so you can make money. And that's why I sold dollar yen with the members, because I already knew the carry trade's coming to an end. It's done. Everyone's unwinding. We sold. We made really good money. Members making thousands of pounds alongside me, trading fundamental macroeconomics. So the question we got to ask ourselves is now, well, why are the markets betting on rate cuts in the United States? Well, again, it's all down to fundamentals. Last week, the unemployment rate in the US went from 4.1 to 4.3. Remember, the interest rate the unemployment rate in America was at 3.7% in January. A 0.2% rise in the unemployment rate for a 300 million population is a lot of jobs, guys. That's like 600,000 people losing their job. And when you're taking a rate from 3.7 to 4.3, you're talking millions of people are losing their job. Why are they losing their job? Well, the Fed was trying to get inflation under control. Okay, as we already know, inflation was way out of control in 2022. And they raised interest rates to bring down prices. Mortgage payments go up, credit card payments go up, car loan payments go up, student debt payments go up. Everyone's interest payments go up. It squeezes consumers. People can't spend as much. Businesses who have been hiring a lot of people because the unemployment rate was very low are paying a lot of salaries to all these people. But if their sales start to slow down and businesses are not making as much, what are they going to do? They're going to slash workers straight away to save money. When you slash workers, businesses are saving money on wages, and then you see the data of wages coming down. So as they're paying less salaries and they're paying less to new people coming into their job because there's now more people seeking employment because millions of people are losing their jobs, well then businesses have the room to cut prices because they're not paying as much anymore. And that's exactly what the Fed's done. So the Fed has been able to get inflation down to 2%. That's one part of their mandate. Price inflation stability at 2%. But then they have maximum employment, which is another mandate they have. And they don't want this to get out of control when millions of people are losing their job. And this is why the markets are pricing in steep interest rate cuts. The markets are fearing the Fed has waited too long to cut interest rates, and now the unemployment rate is rising. That's why they're betting on these rate cuts. And Japan finally has had inflation, which they haven't had for like 35 years, because thanks to COVID and the all supply chain issues, which I'm sure you guys are aware of. So to cut a long story short, I am giving all my members this information. If you would like to come and get updates every day where you know where interest rates are going, you're going to get access into this channel where we're going to give you and we're going to tell you where interest rates are going. So every day you're going to know, for an example, where is the European Central Bank interest rate going? Where is the Federal Reserve interest rate going? And you're going to have access to the spreadsheet I was just showing you over here. You're going to be able to download this part of the spreadsheet, and you can then look at where the interest rates are expected to go. So let's say the US interest rate is going to go down to 3.6 and the European interest rate is going to go down to next year 2.2. Well, then you can quickly come over here and you could say, well, if I was to take a Euro USD trade, where's the interest rates going to go? Who's going to have the higher interest rate, right? And most importantly, the key is, where is it going from where it is today? Okay, because if it goes in favor of the US, well then, you know, if you sell euros, buy dollars, you're going to get paid more interest on that side of the trade. You know, investors are going to take that side of the trade. Who the hell in their right mind is going to sell the dollar to buy the euro and lose money unless the difference, which has been very favorable in the US, is starting to come lower, like I showed you in dollar yen. So all you need is the information. You just need the knowledge. And when we're trading currencies, we're always trying to see who has the higher interest rate over two countries. The United States. Is that interest rate difference going in favor of the US more? And this is why we have to understand where the markets are predicting interest rates to go. Because if the markets, let's say they were predicting interest rates in the US to go up, and let's say rates in the US hypothetically right now was 2.5%, but you know the markets are saying they're going to go up to 5.5% in the next year, well then you're looking at that saying, hold on, I know that investors are going to be making 90 grand a day today, but in the next year they'll be making 150 grand a day free interest. Well, now you know why a currency pair would be shooting up in value, because everyone's chasing that carry trade. And then if you look at the interest rate expectations, which will be given you guys in a lot of information in the channels, and you're saying, oh shit, I know the interest rate right now is where it is, but it's going to go down to 3.5 here and 0.5 here. Oh shit, they're not making 100 grand a day, they're now making 80 grand a day. Oh, I know everyone's going to cash in on that trade. I can now take a speculative bet in the markets and I can make a profit. So guys, if you want to trade currencies professionally, you have to have this information. If you don't trade this information, you're not ever going to get on the right side of the markets, and you'll never understand why the headlines are telling you with the carry trade. You'll just be blind. And where the markets are crashing, you don't understand. Okay, so I would love to give you this information. Below this video, click the link. You're going to get access into this channel. Every day you're going to get these updates on where interest rates are going. You're going to get the spreadsheet for you to download so you can see exactly how much you're going to be making on the trade. If you want to get your hands on this spreadsheet where you get all of this data, well then you can take my online courses where I educate members on the macroeconomic fundamentals. But you will get this download for you to calculate the interest rate differences, because all you're going to need is this data here for you to plug in your numbers and know where interest rates are going to be going. It's that simple. And then you're going to be able to follow my trades as well. And I'll share with you all these trades I'm taking with all these members who are making money alongside me. And I'm going to give you educational daily market updates for you to get in these trades and make some money. So guys, come and get involved, man. Powerful time. Just understand the fundamentals drive markets. It's all macroeconomics. It's all fundamental. It's not day trading. It's not chart patterns. It's not technicals. I'm sorry to break your heart, guys, but that's why you're finding it inconsistent. This is the way to do it. We got to do it professionally. Smash the link below. I'll see you in the channels and let's make some money.
Okay, cool.